Welcome to PerfPod, your go-to podcast for everything related to performance management. Whether you're a student or a seasoned professional, you'll find valuable insights and updates here. PerfPod episodes will be short, snappy, and are particularly targeted at ACCA students studying for performance management or advanced performance management exams. They'll include technical content, exam techniques, and real-world applications, giving you the best chance to pass these two tricky exams. I'm your host, Richard Guyver, also known as the Dentist Accountant. Today we're following on from the previous podcast and diving into two more decision rules. And the two we're doing today are expected values and Minimax regret. And once again, both can come up in performance management and advanced performance management. However, they're both a bit more challenging to do as a podcast as they're often quite visual. We'll start with expected values. Some people find this intuitive, but not everyone does. What we do with expected values is we assign probability. So for example, if we've got an 80% chance of making £1,000 and a 20% chance of making £100, we do 0.8 times 1,000. We add that to 0.2 times 100. We add them together and we get 820. In the exam, using the spreadsheet function is often good for doing expected values, particularly if there's several lines of calculations. One of the things to consider is the actual outcome will either be 1,000 or 100. In that example I just gave, it will never be 820. But if we repeated this project 100 times, on average the return would be 820. And that leads to one of the limitations of expected value. It's not a good technique for one-off projects. For example, if you wanted to launch a new business, expected values is not necessarily the right method to use. But if you're carrying something out on a repeated process, so maybe a company releases lots and lots of new products, then expected values are a good method because it works out the average result over time. So the main limitation, as we just said, is it's only valid if the project is repeated many times, because it doesn't give an actual outcome. That can also confuse some people. So if you're reporting to non-finance people, they can often be surprised or confused when the actual outcome is different to what the expected value estimates. It also ignores a range of outcomes, and that's one of its other limitations. Now, Minimax regret. Might need to rewind this a few times and listen, because it's certainly the hardest of the decision rules to understand, and it's much more visual. So we think of regret as opportunity cost. Minimax regret aims to minimize the maximum opportunity cost for each decision. I'll say that again. It aims to minimize the maximum opportunity cost for each decision. When we're to think about it, there are two aspects with each of these decision rules. There's the decision we make, and then there's always some factor which is outside of our control. Could be the weather, could be the economy, something like that. With Minimax regret, we look at the opportunity cost and we create what's called a regret table. And the way we create a regret table is we look at each of those outside factors, be it the economy or the weather, and what would have been the best decision to have taken with the benefit of hindsight. So let's take the economy example. If we think that the economy could perhaps be a strong economy, a weak economy, or a shrinking economy. And what we do is we assume if the economy is strong, what would have been the best decision we could have made? And then we look at those other decisions we could have made and work out the difference from that best decision. And that's our regret, that's our opportunity cost. And then we take the weak economy and we say which would be the best decision if the economy turns out to be a weak economy. And then from that we look at the outcome based on the other decisions we could have made, and those differences are the opportunity cost. And then we look at a shrinking economy and we go, what would be the best decision to make if the economy was shrinking? And once again, we compare that to the other decisions we could have made, and those are our opportunity costs. Then we take that regret table, which will now identify the maximum regret, i.e. the maximum opportunity cost of each decision we could have made. We identify the maximum for each, and then we choose the lowest of those. And once again, I apologise, it is a very visual thing, and certainly at some point I'll look to do a video for this, which hopefully will make it clearer. We'll now look at the limitations of the Minimax regret. The first is it's hard to understand. A lot of people struggle with it, and that's definitely one of the limitations. And like some of the others, it also ignores probabilities. A couple of podcasts back, we looked at risk profiles, and we identified the three main risk profiles that are used in these exams as someone being risk adverse, risk neutral, or risk seeker. And it might be worth recapping all of those now. So a risk averse person or organisation will either use maxi-min, as we said in the previous podcast, or they will use Minimax regret. Someone who's a risk seeker, and this was covered last time, would use Maximax as the decision rule. And someone who's risk neutral would use expected values. So in summary, today we've looked at expected values and Minimax regret decision rules. And next time we're going to stay on the topic of risk and uncertainty and take a look at sensitivity testing and scenario testing. Well, thanks for tuning into PerfPod. I hope you found this episode informative. As always, I'd love to receive feedback in the comments, and if you've got any topics you want us to record in future, please do say so. And as always, please share this with colleagues who you think might find it useful. Until next time, this is PerfPod signing off.